Now let's look at the income statement. An income statement records a company's total earned revenue and total incurred expenses over a period of time. So the top line starts with the net sales, or say the revenues. And after the sales and the revenues, we would have different kinds of costs and expenses. And the bottom line of the income statement would be the net income available to common stockholders. And we can think of that as a difference between the sales, the top line, and the different kind of cost expenses. So the process is to subtract the costs and expenses from the net sales to eventually get to the net income available to common stockholders. We can also see that the top part of this income statement, we have the process of getting the so-called operating income. We want to see how much income is generated from the company's operating activities. And that is after you subtract the main operating costs and expenses from the sales. So we end up with the operating income, or say the earnings before interest and taxes, which is also called the EBIT. Once we have the EBIT, we can subtract the interest from the EBIT to get the EBT, earnings before taxes. And then we subtract the taxes from the EBT to get net income before preferred dividends. So that is when we consider different obligations in terms of the financing and taxes, because you pay interest to your debt holders and you have to pay tax to the government. So those are the obligations from the financing and tax concerns. And if the company has preferred stocks, then the company also has to pay preferred dividends. Once the company pays preferred dividend, then the final result will be the net income available to common stockholders. So this is figure 2.2 from the textbook about a basic income statement. We can also look at this sample income statement from the DPH Tree Farm Income. We have the income statement as of the year of 2017 and 2018. If you look at the bottom part of this income statement, you see they provided some per share data. So these are the information provided by the company to summarize their performance. So the first one is EPS, earnings per share. Earnings per share is simply the earnings, which is actually the net income available to common stockholders. The result you have here, common stock, net income available to common stockholders. They belong to all the common stockholders. So then if you look at how many shares are there, total number of shares of common stocks outstanding, you can then calculate a per share figure. So out of one stock, one share of the common stock, how much is the earning? So that is the concept of earnings per share. And we also have the dividend per share, which is the common stock dividends paid. The total amount divided by the number of shares outstanding, that is to give us on a per share basis how much would you receive if you have one share of the common stock. We also have the book value per share, BVPS. That's simply the total book value of the company's common equity, which is the number you can find from the company's balance sheet. You use that number divided by the number of shares outstanding, you get a book value per share. Now the book value here on the top, that includes all common equity book value, including common stock par value and paid-in surplus, and also the retained earnings. The last one, they call it market value per share. That's actually simply the stock price of the company's stock in the market. So end of 2017, the stock was traded at $15.60. And 1 year later, it was traded at $17.25 per share. So that's the stock price, and you can also call it the market value per share. So once you understand the basic structure of the income statement, we can take a look at this practice question from the end of chapter 2, practice the problem set. So we have this company, according to its 2018 income statement, we have the EBIT number, we have the interest and tax. So if we have the EBIT, we subtract the interest from the EBIT, we get EBT, and then we subtract tax from the EBT to get net income. Now, this company has no preferred stocks outstanding, so there will be no preferred stock dividend, which also means all the net income will belong to, or say will be available to common stockholders. So to calculate the EPS, earnings per share is the amount of net income available to common stockholders divided by the number of shares. So to get the net income available to common stockholders, like I said, you subtract the interest expense from EBIT, and then you subtract the tax from the EBT. Your final result is $439,000 divided by 100,000 shares outstanding. So per share wise, the company's EPS is $4.39. So that's a simple example of calculating the company's EPS. Recall, in the last video, we talked about how leverage, financial leverage, can magnify investors' returns. So now, since we reviewed both balance sheet and the income statement, we can try to use some numbers to demonstrate that idea. So if we are looking at two companies, one is called All Debt, the other one is called All Equity, and they have identical operating income. So you see in this table, we have both companies starting at the same amount, 5 million operating income. And then we have the All Debt company. Apparently they have a lot of debts. So their 12 million assets is financed by 11 million in debt and only 1 million in equity. And for the 11 million debt, they have to pay 10% interest. That's why the interest expense each year will be 1.1 million, which is 10% of the 11 million debt. So you subtract the interest expense from the operating income, you get the taxable income. This is a standard process you've seen in the past couple of slides about how to calculate the EBT and eventually the net income. So once you have the EBT, 30% will be paid as tax. So tax will be 30% of 3.9. That will be 1.17 million. So net income will be 2.73 million. If we look at the All Equity, this All Equity company finances 12 million with no debt. No debt, therefore no interest expense. And the taxable income then will be the same as the operating income because you don't deduct any interest expense. 30% of the taxable income will be 1.5 million. After that, net income will be 3.5 million. So if you only look at net income, which belong to or say are available to common stockholders, equity holders, it looks like All Equity, this company has more net income for shareholders. However, if we think about all investors, including debt holders and shareholders, this company, since they pay 1.1 to debt holders, and then there will be 2.73 left for shareholders. That's a total of 3.83 million for investors, all investors, comparing to the 3.5 million to the equity holders, because for this company, they only have equity holders. So then, if we compute the return, 3.83 million out of 12 million investment from both debt holders and shareholders, that will give us about a 32% return. Comparing to the other company, All Equity, the return will be about 29%. So this is a little bit higher if you consider the return for all investors. Another way to look at it is if you think about the net income available to common stockholders for the all debt company, it's only 1.73 million. But that is based on only 1 million investment in equity by the shareholders. So 2.73 million divided by 1 million, that is actually a 273% return on equity comparing to 29% for this all equity company. So this demonstrates our idea. You saw in the last video that borrowing money or say having financial leverage actually can magnify the return for shareholders, for investors. And of course, that is if the company is making positive profits. The next statement we want to look at is the statement of cash flows. This is a statement that shows the company's cash flows over a given period of time. So for example, here you see this is the company's statement of cash flow as of 2018. So the idea is we would only include cash inflows and outflows, and we try to exclude the transactions that have no direct effect on cash receipt and payment. For example, depreciation expense, it would be recorded in the income statement as one of the operating expenses. However, there's no cash payment as depreciation expense. You do not pay anyone the depreciation expense. It's just you record that depreciation expense on your income statement. So that's why depreciation expense would not be deducted in the statement of cash flows. Actually, since we use a so-called indirect method, which is to adjust the net income numbers to construct the statement of cash flow, we actually adding back the depreciation expense. We add it back because this number was subtracted in your income statement to calculate the net income. So again, this is from your previous accounting classes about the details of constructing the statement of cash flows. We're not really interested in all these details of constructing the financial statement. Instead, we just try to take a look at the statement and see how can we interpret the numbers. So the statement of cash flows, the bottom line here is net change in cash and marketable securities. And this numbers, this final result here, should be consistent with the change in cash in the company's balance sheet. So remember, this is a -1 net change in cash in the company's cash and marketable securities. If we go back to the company's balance sheet here, we notice in 2017 the cash and marketable securities was 25, and in 2018 it's 24. So the difference is a -1 million, which is consistent with the -1 million net change in cash and marketable security here. Anyway, like I said before, we don't want to spend too much time talking about the construction of the cash flow statement. We actually focus more on, for example, understanding that this cash flow statement reflect the company's use and source of cash from its operating activities, investing activities, and financing activities. So you have the section A, B, and C. If we look at part A, or say section A, cash flow from operating activities, these are items directly associated with the company's main operations. So we try to go with the company's net income, and we add back the depreciation, and then we look at some working capital accounts. Again, if you have current asset increase, that would be considered as cash outflow or use of cash. If you have current liabilities decrease, that would again be considered as use of cash. So these would be subtracted from the total. On the other hand, if you do see current asset such as the inventories or account receivables, if you see they decreased from 2017 to 2018, or if you see the current liabilities increased from 17 to 18, those activities will be identified as the source of cash, or say providing cash inflows, and those amounts will be added into the total cash flows. So depending on this company's balance sheets, you compare 2017 and 18 numbers, and you identify that the accruals increased, so there will be cash inflow, 5 million added. Another example will be the inventory. Inventory amount increased, so increasing the current asset balance. So that number will be subtracted because that's considered cash outflow, use of cash. Now if we look at the investing activities, so what are the major investing activities for the company? You basically spend money buying the long-term assets, fixed assets, such as the buildings or machines or equipments. This company, they spend about 68 million. So we subtract the 68 million. If you see the company's fixed asset decreased from 17 to 18, that may suggest that company has liquidated some of its fixed asset, then the number should be added because that transaction would provide some extra cash for the company. Now let's look at the last section, section C, cash flow from financing activities. If the company issued more debt so that they would have an increase in long-term debt, or if they issued common stocks or preferred stocks, so they would have increase in common and preferred stock, those numbers will be added here as the source of cash. When the company used cash to pay dividends, including preferred stock dividend and common stock dividends, then those amounts will be subtracted because that will be the cash outflow or use of cash. And when you sum up the net cash flow from all the three activities, you get the final result, which is section D, net change in cash and marketable securities. And usually I describe this as A plus B plus C equals to D because the final result is the total of the net cash from all three different activities. So now once you understand the structure of the statement of cash flows, let's look at a practice question. If we have this company, they have cash flows from investing activities of this much, financing this much. As a result, the balance of the company's cash was this much at the beginning of the year and then different number at the end of the year. The question is, how much is the company's cash flow from operations, or say operating activities? So the question essentially is that it gives you the information about cash flow from investing activities, financing activities. You can also try to find out what is the net change in cash if you look at the beginning of the year and the end of the year. So you find out the difference, which is the net change. So then look at part A, B, C, and then section D. How much does the cash flow from operating activity have to be so that the total amount will make a positive $127,000? So the result is about a little bit over $10 million. So this company has made over $10 million, and because of that, even if after they spend so much money in investing and financing, they still have an increase in the cash balance over 2018.